Welcome to the Deep Dive. We sift through earnings calls, market data, all that stuff, and pull out what you really need to know. Today, we're plunging into the Q2 2025 results from SB Financial.
Yeah, this one's interesting. It's a regional bank, maybe not on everyone's radar, but they're making some moves in a pretty tricky market. Delivered some really compelling numbers this quarter, especially considering they just digested an acquisition.
Absolutely. So our plan today is to, break down the financials, get a sense of management strategy, and figure out what this means, especially if you're watching the regional banks. Can a community bank actually expand its margins right now? Let's see what SB Financial is doing.
Exactly. We should get a pretty clear picture of, how they're growing, how they're managing assets, and positioning themselves. And this is all coming straight from their latest earnings call insights. We'll look at revenue, loans, capital, the whole picture.
Okay, let's kick things off with those headline numbers. They kind of set the stage, right? SB Financial reported GAAP EPS, that's earnings per share of $0.60. Pretty strong jump, 27.7% year over year.
Right.
And even if you look at adjusted EPS, which takes out a sort of one-off gain they had.
The surfacing rights thing.
Yeah, exactly. That still came in at $0.58. So up 26.1% year over year shows good underlying strength,
Definitely. And that earnings growth, it's really backed up by the revenue side. Operating revenue jumped 22.3% year over year, came in at $17.18 million. Yeah. And the main engine there was net interest income, up over 25% to $12.13 million. Management really called that out as the core driver.
Right, the center post, I think they called it. But non-interest income wasn't exactly sleeping either. That was up about 15% to just over $5 million. But the number that really jumps out, especially now, is the net interest margin, the NIM. It expanded pretty significantly to 3.48%. That's 36 basis points higher than last year?
Yeah, 0.36%.
And it's the highest it's been since late 2022. Getting that kind of margin expansion when funding costs are still a headache for many banks, that's notable.
It really is. It shows they're managing both sides of the balance sheet effectively. Funding costs and getting loans repriced higher. And speaking of the balance sheet, loans kept growing, up 8.9% year over year to $1.09 billion.
And that wasn't just year over year, right? They added loans compared to Q1 as well.
Yeah, about $6.4 million sequentially. So steady momentum. Deposits also up 12.1% year over year, hitting $1.25 billion. And crucially, tangible book value per share, a key metric for banks that was up 7.7% year over year, $16.44. Real value creation there.
Yeah, and management seemed to agree. They bought back 124,000 shares in the quarter, average price just under $19. And the dividends holding steady at $7.15 Senko quarter. Payout ratio around 25%, which is, right in line with their history.
Right.
So overall, looks like a really solid quarter, good execution, confident management, disciplined approach.
Definitely. But the numbers only tell part of the story. Right. The strategy behind them is just as important, especially with that recent acquisition.
Okay, yeah, let's unpack that. A Marblehead Bancorp deal closed back in January. Q2 was the first full quarter with them on board. Integrations can be messy. How did this one go? What did management say?
Well, that's always the key question with M&A, isn't it? Integration risk.
Yeah.
But what's really striking here is the deposit retention. Management said almost 100% of Marblehead's deposits were still there 6 months later.
Wow. Nearly 100%.
Yeah, that's huge. It basically proves the deal logic, expanding their footprint, creating that sticky funding in Northern Ohio. For a regional bank, having depositors who aren't just chasing the highest rate, that's a massive advantage. Helps keep funding costs down.
Okay, that makes sense. So shifting back to revenue drivers then, that net interest income acceleration, $12.1 million, accelerating at a 30% annualized clip from Q1. That's serious momentum.
It is.
And management sounds pretty bullish on NIM expanding further, which, like we said, is kind of going against the grain for some banks. How are they planning to keep that going?
Well, they're guiding for potentially another 10 basis points of NIM expansion in Q3. So aiming for around 3.7%. Now, they did say that depends on funding costs staying stable.
Sure. Always a caveat.
Always. But it's based on a couple of things. One, they've got loans repricing higher. They mentioned about $100 to $150 million rolling over in the next year. And two, crucially, it links back to that deposit retention. They're not having to, chase yield, offer crazy high rates to keep those deposits.
Right. Customer relationships, the integration success. It all feeds into managing that cost of funds.
Exactly. Beyond NII, non-interest income was strong too. Helps diversify things.
Yeah.
Mortgage originations bounced back nicely, almost $98 million. That's up from last year and last quarter.
Okay.
And their title company affiliate, Peak Title, closed over 560 transactions already this year. That's up more than a third compared to the first half of 24.
So it's not just about the core lending spread. They're building these other fee income streams.
Absolutely. The Indianapolis mortgage team actually had its best quarter ever since they started it back in 2019. Shows those targeted investments are working. Their servicing portfolio is now about $1.5 billion that generates steady fees. And they also teased a new wealth management partnership coming in Q3, trying to beef up resources there. It all adds up to being less reliant purely on interest rates.
Makes sense. Okay, what about loan growth itself? Fifth straight quarter of sequential growth, you said.
Yep. Consistent execution. And Columbus, Ohio seems to be the engine room there.
The shining star.
Yeah, their words. Driving a lot of growth, especially in Community Reinvestment Act type lending.
So they're being pretty targeted about where they grow.
Very much so. Seems like their playbook is classic community banking. Find markets where bigger competitors are maybe pulling back or getting disrupted by their own M&A.
Right, taking advantage of those cracks in the landscape, as they put it.
Exactly. Using a hybrid office model, focusing on relationships. Plus, they mentioned they have about $40 million in construction projects already approved but not yet funded.
Oh, okay. So there's a built-in pipeline there.
Yeah, they expect $10, $15 million of that to fund each quarter for the next year. So that provides a nice baseline for continued loan growth.
Gotcha. All right, crucial topic. Asset quality. Always top of mind for bank investors. How are things looking on the credit front? Any concerns despite the good headline numbers?
It's looking pretty solid, actually. Charge-offs dropped back down to less than 2 basis points. So really low, back to sort of historical norms after a slight uptick in Q1.
Okay, that's good.
Non-performing assets were about $6.2 million. Management sounded pretty confident about resolving those positively in Q3.
Which has implications for provisioning, right? How much they set aside for potential losses.
Exactly. They put aside $1 million in the first half of the year. But they signaled they don't expect that pace to continue. If those non-performing loans get resolved well, provisioning could be lower in the second half, maybe even get some interest and fees back.
Which would be a nice little boost to earnings.
Could be. And importantly, their overall allowance, the cushion for potential losses, is still really strong. It's 1.43% of total loans. That covers their current non-performing loans by 265%. So a very healthy buffer.
Okay, good to hear. And wrapping up the operational side, expenses and capital. Expenses were down from Q1.
Yeah, down about 4.5% from the linked quarter. That makes sense, though, because Q1 had some one-time costs related to the Marblehead conversion. So things normalized there.
Right. And the buybacks. They bought shares in Q2, but you said they signaled a slowdown for Q3. Why the shift?
It sounds purely strategic. Management explicitly said they want to preserve capital flexibility. They're keeping their ear to the ground, as they put it, for potential bolt-on M&A deals.
Ah, okay. So holding back on buybacks to maybe fund an acquisition instead. Disciplined capital allocation.
Precisely. Looking for the best use of capital, not just buying back stock automatically. Yeah. Oh, and one other thing on the capital front, they were added back to the Russell Small Cap Indexes in June.
Oh, that's significant, isn't it? For visibility.
Yeah, definitely. Can increase awareness, potentially boost trading liquidity, attracts more types of investors. So that's a nice little win for them.
Okay, so pulling it all together, what's the takeaway for investors watching the regional banks? SB Financial had a strong quarter, positive outlook, but the stock didn't really react much on the day, did it? Down slightly on thin volume.
Yeah, that muted reaction, it's actually not that unusual for smaller, thinly traded stocks like this. It doesn't necessarily mean the market hated the results. Liquidity can play a big role in the immediate price move.
Right. Need to look bigger picture.
Exactly. And if you look over the past year, SB Financial stock has actually crushed the benchmark's total return of 27.8%. Compare that to the S&P 500 ETF, SPY, at 14.5%, or even the regional bank ETF, KRE, at 16.1%.
Okay, so the market has been rewarding their performance over the longer term. That outperformance tells a story.
It suggests investors are buying into the strategy and the execution, looking ahead, catalysts for the second half, definitely watching for that continued NIM expansion they guided for in Q3, seeing how those credit resolutions play out, how the mortgage business performs versus their forecasts. And of course, the big one, any potential M&A news, that could be a real needle mover.
Yeah, absolutely. And the broader backdrop for community banks seems to be improving a bit, right? Funding costs, stabilizing, maybe some margin relief?
Generally, yes. Right. You saw the KRE ETF actually outperform the S&P 500 last quarter. Suggests sentiment is getting better, partly hopes for eventual rate cuts, maybe easing credit concerns. SB Financial seems well positioned to ride those trends,
Right.
building bigger, more diverse platform, compounding that tangible book value.
All right, perfect time then for our This Is Not Financial Advice segment. Purely a thought experiment, folks. Wild ideas, maybe plausible, definitely not recommendation.
Okay. Well, considering everything we've discussed, strong results, that focus on M&A, slowing the buybacks to save capital, here's a thought.
Lay it on us. Eyebrows ready to be raised.
Given that ear-to-the-ground comment from management and the fact that regional bank M&A could pick up, you could, theoretically, consider a long-dated, out-of-the-money call option on SB Financial.
Okay, untack that. Why that specific play?
The idea is leverage. If they do announce a good acquisition, one that really adds value, expands their reach or diversification, the market could react very positively. And given it's a smaller, thinly traded stock, that reaction could be sharp.
Right. News can have an outsized impact.
Exactly. An out-of-the-money call option is relatively cheap. It gives you the right to buy the stock way higher than it is now, but only if it gets there. So if that M&A catalyst hits and the stock jumps significantly, the option could provide a much bigger percentage return than just owning the stock.
So it's a bet specifically on that M&A catalyst creating a big pop. High risk, potentially high reward if they pull off a good deal.
Precisely. Playing the optionality. But again, just a thought experiment. Highly speculative. For entertainment only.
Understood. Okay, that brings us to the end of our deep dive into SB Financial's Q2 2025. We've seen a bank firing on most cylinders, strong results, successful integration, clear strategy.
Yeah, their focus on margins, diversifying revenue, being smart with capital, it really positions them well within that regional banking space. They seem ready to capitalize on opportunities.
Definitely some interesting themes to consider. We hope digging into this specific example gives you some food for thought about the broader sector. Maybe think about how smaller players can execute and find ways to grow even in challenging times.
And always remember, everything we discuss here on the deep dive is just for informational purposes. It's definitely not financial advice.
Thanks for tuning in. We'll be back soon with another breakdown.